U.S. Treasury Secretary Scott Bessent announced that the United States has finalized a $20 billion currency swap agreement with Argentina's central bank and has already intervened in the Argentine foreign exchange market by purchasing pesos directly. This financial support comes ahead of Argentina's legislative elections on October 26th. Immediate intervention. Bessent stated that Argentina faces a moment of severe illiquidity and that the U.S. is prepared to take exceptional measures to stabilize markets. The intervention had an immediate impact, causing the dollar exchange rate to fall and reducing the currency gap. Immediate intervention. Bessent stated that Argentina faces a moment of severe illiquidity and that the U.S. is prepared to take exceptional measures to stabilize markets. The intervention had an immediate impact, causing the dollar exchange rate to fall and reducing the currency gap. Presidential praise. President Javier Milei praised Economy Minister Luis Caputo as, by far, the best economy minister in all of Argentine history, and thanked both Bessent and Trump for their support. Strategic rationale. The Treasury Secretary emphasized that the aid supports Argentina's fiscal discipline and structural reforms, noting that a strong and stable Argentina contributing to a prosperous Western Hemisphere is in the strategic interest of the United States. China factor. In a Fox News interview, when asked what the U.S. gets from the swap, Bessent responded, "We get a lot out of it." Milei is committed to removing China from Argentina. He also stated this isn't a bailout, but rather, buy low, sell high, the Argentine peso is undervalued. Domestic opposition. The agreement has faced domestic opposition in the U.S., particularly from Democratic lawmakers like Chuck Schumer and Elizabeth Warren, who criticize using American funds to help Argentina compete against U.S. farmers. The U.S. Treasury is prepared immediately to take the exceptional measures necessary to stabilize the markets. Scott Bessent. This agreement represents a clear geopolitical play by the Trump administration to counter Chinese influence in Latin America. The explicit mention of Milei's commitment to removing China from Argentina reveals the true strategic motivation behind the financial support. This isn't merely economic aid, it's part of a broader U.S. effort to reclaim influence in its hemisphere. The timing is crucial. With Argentine legislative elections just weeks away, October 26th, this financial lifeline provides immediate political capital for Milei's government. The rapid market response, falling dollar rates and reduced currency gap, offers tangible relief that could influence voter sentiment. Despite Bessent's optimistic framing, buy low, sell high, currency interventions carry significant risks. Argentina has a long history of currency crises and economic instability. The $20 billion swap is substantial, and if Argentina's economy doesn't stabilize, U.S. taxpayers could bear losses, hence the Democratic opposition. The domestic U.S. opposition is noteworthy. Democratic senators are framing this as Trump prioritizing foreign interests over American farmers and struggling families. This criticism highlights the political vulnerability of the deal, particularly given concerns about food prices and cuts to nutritional assistance programs. While Bessent didn't specify formal conditions, the China comment suggests implicit expectations. The U.S. appears to be leveraging Argentina's financial distress to secure geopolitical concessions. This raises questions about sovereignty and whether Argentina is trading economic dependence on China for dependence on the U.S. The immediate positive market reaction, falling dollar rates, rising bonds and stocks, demonstrates the power of U.S. financial intervention. However, the long-term sustainability depends on Argentina implementing the structural reforms that both the U.S. and IMF are demanding, a politically challenging task even with a more favorable Congress. The involvement of IMF Director Kristalina Georgieva and her public support suggests coordinated international pressure. The U.S. is essentially acting as the fast-moving partner while the IMF provides legitimacy and technical oversight. This partnership could set a precedent for future interventions. The IMF's 2025 program for Argentina centers on maintaining a zero-deficit rule, transitioning to a more flexible exchange rate regime, and implementing structural reforms including pension system changes, tax reforms, revenue sharing between federal and provincial governments, privatization programs, labor market reforms. The program requires Argentina to maintain a primary fiscal surplus of 1.6% of GDP in 2025, rising to 2.5% of GDP over time, with reforms in pensions, taxation, and public expenditure efficiency. The positive side. Argentina reduced child poverty by 1.7 million in 2024, despite aggressive austerity, with UNICEF projecting that child poverty would fall to 47.8% by the first half of 2025, down from over 67% in early 2024. The concerning reality: despite overall improvements, poverty remains deeply entrenched among certain groups. Children in households where the head didn't complete primary school, 80.9% poverty rate. Children in informal settlements, 72.3% poverty rate. Children in single-mother households, 60% poverty rate. Paradoxically, social spending in Argentina is skewed toward the elderly population rather than children, despite poverty being higher among children and adolescents, resulting in chronic poverty and lack of social mobility. Impact on the elderly. The harshest consequences. Devastating pension cuts. Pension spending fell from 7.6% of GDP in 2022-2023 to 6.5% in 2024. Budget allocations for pensions dropped by at least 25.8% in real terms in the first 7 months of 2024. The average retiree earns around $320, which is below the government's poverty threshold. Austerity measures reversed 100% coverage of medicines for 5 million pensioners. The stark reality: the minimum pension is currently around $230, but the basic basket of goods for retirees costs approximately $918, meaning pensions cover only about 25% of elderly people's basic needs. In August 2024, Congress passed a pension reform bill to adjust pensions monthly according to inflation with an 8.1% compensation. But President Milei vetoed it to maintain the zero deficit target demanded by the IMF. Many retirees can no longer afford their medications. One example: a pensioner whose 3 medications cost $200 while his pension is only $300, leaving just $100 for food, utilities, and all other expenses. Argentina faces a profound paradox. It allocates significant resources to fighting poverty and has good programs, yet poverty hasn't fallen below 25% in 40 years because the economy doesn't grow sustainably and doesn't generate quality employment. This creates a vicious cycle where more people increasingly require social assistance. The IMF has pushed for a zero-deficit policy while simultaneously noting the need to protect the most vulnerable, creating an inherent tension in policy implementation. In practice, the fiscal adjustment has disproportionately fallen on those least able to bear it. A question of values. The situation is particularly cruel for the elderly, who after working their entire lives find themselves living below the poverty line, unable to afford basic necessities including life-saving medications. This raises fundamental questions. Is fiscal balance worth sacrificing the dignity and health of the most vulnerable? Can an economy truly be considered successful when pensioners can't afford food and medicine? Who ultimately pays the price for macroeconomic stability, the markets or the people? While the US-Argentina deal may stabilize markets and counter Chinese influence, its success will ultimately be measured not in currency rates or fiscal surpluses, but in whether ordinary Argentinians, especially children and the elderly, can live with dignity. While the US-Argentina deal may stabilize markets and counter Chinese influence, its success will ultimately be measured not in currency rates or fiscal surpluses, but in whether ordinary Argentinians, especially children and the elderly, can live with dignity.